Welcome to Beyond the Flight Deck podcast with United Airlines pilot and investment advisor, Alan Bewley, who will take you behind the scenes with airline pilot entrepreneurs, academics, and other professionals. And now, your host, Alan Bewley.
All right. Dan, good to see you, my man. How are you today?
Good to be back. Everything's good.
You've been
Spring
flying?
is here. No, I got a couple days off, trying to wait for landings class to get scheduled. So I've sent a couple emails out about tentatively scheduled meetings, and that we may have to be flexible on those, but it's all good.
The dreaded center seat and coach to landings class. We can all relate. Very good. All right. I got back from Munich yesterday. Got Geneva next week. So summer's about to hit. Time for some fun. So we're going to chat a little bit today about things that affect everyone, things that affect just active United pilots. I'm going to kick it off and talk just a little bit about evidence-based investing, kind of what we've seen. So Dano would just kind of rehash what it really is. What do you think? I think the easiest way to look at evidence-based investing is just why we invest in equities versus, say, 1 month T-bills, right? So if you invested in equity, if you look back over the last 100 years, equity returns have way, way outperformed 1 month T-bills. 1 month T-bills are about what, in line with inflation, something like that over the last 100 years, where equities are closer to 10% or almost three times plus inflation over the last 100 years. But there's a catch, right? So there are times when equities not only provide negative returns, they underperform T-bills during certain periods of times, and also they provide negative returns. And some of those times aren't great. I don't know how many people really know this, but maybe a longer time period, but 99 to 09, U.S. equities underperformed. They were negative, annualized negative, like 2 or 3% a year for that whole decade. There may be longer. There are other 10-year periods. That's just the most recent one. So stock returns are actually negative. In particular, large cap growth stocks like S&P was the worst. But the other interesting thing is that there were 16 years from 66 to 82, I think, where stocks were positive, but they still underperformed T-bills, 1 month T-bills, that whole 16-year period. So that begs the question, do we abandon equities just because they provided either sub 1 month T-bill returns or actually outright negative returns for long periods of time? And as evidence investors, we're like, no, we'll take that 100 years and take that as better evidence. It makes sense too, right? Because you're going to take more risk by owning part of a company. Company fails, we lose our investment. But if the company does well, we enjoy their successes as well. So we don't bail on equities because of either long time periods when they underperform, say, T-bills, or actually provide negative returns. The equity risk premium, right? That's what we're capturing. We capture that substantially higher return over time by sitting through those periods. So what's been the hottest market? What's been the hottest part of the market in the last 15 years? What's everybody talking about these days?
S&P 500.
S&P 500, like incredible. Did you get many client questions back in January, February? Why didn't I do as well as the S&P last year? Did you get any of those questions?
Yeah. It's not too uncommon. Or why didn't I do as well as this target date fund or something along those lines, which is heavily invested in the S&P 500.
Sure. But in 21 and 22, when we did better than those, did anybody call you congratulating us? Just out of curiosity.
No.
No. It's crazy how that works, isn't it? Right. So, all right. So there's actually about over the last 15 years, S&P 500 type stocks, large companies, and mostly companies with higher prices relative to their business metrics, large cap growth stocks. Those have wildly outperformed the historical norms, over the last 15 years compared to, say, the last 100 years. Where the opposite of those, smaller companies with lower prices relative to their business metrics, those have kind of performed in line with their historical norms, whereas the others, the large cap growth, the S&P stuff's done a lot better. And so And that's
by the way, this argument can be made back in 1999,
correct.
right before the S&P had a near 0% return for the next 10 years.
It was a sub-zero.
You're right.
Yeah. Yeah.
Right.
So in the 90s, the S&P had done better, probably, I guess. Well, small companies did really well in the 90s, but yeah. So if we go from 09 to the end of last quarter, so April of 09 to the end of last quarter, that's 15 years. If you had dropped $1 in large cap growth, it'd be worth $11 today, but small value only $9.20. So there's that outperformance. But to your point, Dan, the previous 10 years, had you only been in the large growthy S&P, it'd have been the other way around, right? The small value did better, right? So
right.
But,
well,
so,
my point mostly being that everybody wants to look backwards at the last 10 years.
Right.
As to what the hottest thing was. And back then, especially, it was the NASDAQ. There's no question about it. But we can find ourselves falling into the same trap right now of looking backwards and not looking at the historical evidence, as we always refer to.
Sure. So here's a little longer period that we'll look at. So again, last 15 years, if you had $1 invested in large cap growth stocks, which is what's been really hot over the last 15 years, your dollar would be a little over $11 today. If that same dollar had been in small cap value or lower relative price companies, smaller companies, it'd be about $9.20. So about $1.80 difference. You'd have more, coming off that 10 years where large growth did poorly, the last 15's been pretty good. But so now let's go back 45 years, for example, back to 1979. And let's look at it again. So we put $1 in large cap growth over that 45-year period from basically March of 79 till March of this year. Large cap growth, you'd have about $200 today, but small value, you'd have about $460. So more than double. And that's probably a better period of time, 45 years, age 20 to 65, maybe your working years, your working and savings years. But here's the one we really focus on. Let's look about the last 100 years. It's about 98 years. All of our research data goes back to 1926. This is the one that drives it home. And this is where recency bias, right? That's what you're talking about, right, Dan? We're looking at the last 10 years. So that is, well, if this is done great, why aren't we doing just this? Because that's recency of performance, recency bias. So now let's go back 98 years. Again, as far back as the research goes, $1 in large growth, you'd have about $12,400 today. What do you think the small value number is? You want to throw a guess out there? 12,400 for large growth. Yeah. Any idea? Small value?
18,000.
463,000.
Oh, holy cow.
It's not even close.
Wow.
Not even close. So do we really care about the last 15 years? We do, but we honestly shouldn't. We really shouldn't. So that is why we own all of it, right? We own the S&P 500. What are our biggest holdings? The S&P 500 Mag 7. They make up 39%, right? The Mag 7 right now make up 39% of the S&P in terms of dollars. So the Apples, Nvidias, Microsoft, Amazon, that kind of stuff. But again, as evidence-based investors, we look at that huge delta, 12 grand over 98 years versus $460,000. So we're willing to sit through these 15-year periods where we slightly underweight the large companies with higher prices, the S&P type companies, to slightly overweight those smaller companies with lower prices. Why? Look at the difference. I mean, look at the difference in returns over the last 100 years. It's like stocks versus bonds. The long term is very compelling, but to capture that premium, the risk we take are the last 15 years when you might not do as well as a benchmark that you think you're trying to compete against. And the rest of this too, Dan, is that's just the US, right?
Right.
So what was it? That same period of time, 99 to 09, when US equities were negative and underperformed T-bills, the rest of the world provided positive returns if you were in the, invested in the rest of the world. So, yeah. So that's why we diversify globally. And that's why we don't track necessarily with things like the S&P. It's an evidence-based approach. We're going to make small changes to the portfolio. One thing we're getting rid of is one more mutual fund, the Vector mutual fund. We're replacing that with an ETF that's coming up here soon. We're also adding another ETF that captures some of the bigger companies, but ones that are highly profitable. And there's research behind that as well. So why are we doing this? Well, we are working our way away from mutual funds, right? But we're also trying to capture the premiums that we want to capture over time, but maybe with a little less tracking error, meaning that maybe we are a little closer to indexes people are familiar with without sacrificing returns. So we've worked with the research team at Dimensional, and changes to come soon. So did I miss anything there?
No, that was it. Part of we talk about the evidence. I always go back to also that the evidence is one thing, but there's also investor and experience as well. So we have to take that into account, and that's not really much different than a person's risk tolerance. Some people prefer to be more conservative, where the evidence would say you might make more money over time, being more aggressive, but it comes down to preference as far as that goes. So no, I think that's a good recap on evidence-based investing and the changes we have coming out.
Sure. All right. You had some things you want to talk about. Rumor has it.
Yeah, absolutely. So again, something that applies to everybody is, and this is on the radar, it's on the horizon. It's definitely out there. Everybody needs to be aware of, and that is if you remember, I think it's 2017, Congress, the government passed the Tax Cuts and Jobs Act, which lowered tax rates,
Yeah.
and as well as they shifted down the income brackets as to what affects those what those tax rates apply to. So we got a tax cut back then, and that was in the bill to sunset in 2026. So in other words, expire and go back to the old rates, inflation adjusted. So just keep that in mind, that in 2026, we do anticipate at this time rates are going to be high, tax rates are going to be higher, and the income tax brackets are actually going to be slightly lower. It's a little bit of a double whammy as far as what we expect that to happen. So just keep that in mind in all of our planning that we do. We have that built into the plans right now. So if anything favorable happens, they might pass it so it doesn't sunset, but right now at this point, we are planning on it actually sunsetting, and so tax rates would be going back higher a little bit. I've got a cheat sheet that's going to compare tax kind of what the tax rates are right now versus what we anticipate them being in 2026. So if anyone just see that, be happy to provide send that out. We might actually attach it to this email too. So that's the big thing on the planning side that we've got coming out on the horizon. Is the increase in tax rates in 2026.
The other thing I'll add to that as part of it is they doubled the standard deduction back then. And so now a lot of pilots and retirees are just claiming the standard deduction because it's so high. Well,
Right.
For those active pilots, retirees, if you are generous in your charitable giving, and also you're an international pilot where your per diem write-off was traditionally pretty high, you might be back to itemizing deductions starting for your 2026 tax year versus coming back to this. So like Dan said, we kind of anticipate higher tax liability, but that's where you work with your tax preparer and get aggressive legally, with your deductions. So that's the other big part of it for those who donate a lot, and especially the pilots that fly a lot of international with big per diem sheets.
Yeah. So so in the past, there used to be some preparers around that would do the per diem calculations for you and kind of break down what those itemizations can be. That kind of went away over the past couple of years. It just wasn't necessary, but that might be coming back here in 2026. So we can take consider what those itemized deductions are in per diem.
And the company still offers
rates,
those reports. So we still have them. I think they're in Flying Together. You can still get. Yeah.
Yep. So, so moving on. So the next thing to talk about real quick, and this is for active pilots, is check your PRAP contributions. So if you're already maxed out for 2026, let me go back to this year. If you're already maxed out for 2024, 76,500 if you're over 50, you're good to go. You've already maxed out. You're getting RHA spillover for the rest of the year. You're good to go. But remember, in December of last year, they came out with this enhanced PRAP contributions where you can do pre-tax and post-tax concurrently. In my opinion, it just really confused things, and it creates an extra step for going to create a minimum of 2 extra steps for everybody. The point being is that if you did not max out, if you did not do your contributions concurrently, so pre-tax and post-tax at the same time, and you did only pre-tax and you're waiting to turn your post-tax on until you're full, check those contributions. Go and make sure that, see where you are against the limits, $76,500 if you're over 50, and what is it, 69,000, right? If you're under 50. So check those. You don't really want to wait until it's full. You actually want to wait until the month it's going to be full before to change those contributions, because it takes.
You mean your $30,500 or $23,000?
Yeah. Yeah.
The month before that's full, you want to start the post-tax. Yeah. That way you don't have that paycheck to where you only get pre-tax or Roth. And if there's only $1 you've got left to put in there for that pay period and it maxes you out for the year, if you don't already have that post-tax on, it's all the contributions you're going to get that pay period is that $1 of pre-tax or Roth. Yeah. Okay.
Right. And that's the whole reason they did this, is so that you could do pre-tax and raw and post-tax in the same month. But I don't think what they anticipated is that if a pilot is not on top of this, then they're going to end up going, like, for example, somebody says, oh, sure, I should wait till it's full till I change it. No, you should actually wait until it's about full to change it. And then I've been in touch with clients as to when they make their changes, tell me when it takes effect, because there's no published deadline. There's no published date during the month as to when you make a change, which pay cycle or which paycheck it actually contributes to, or it takes effect from. I've had one client tell me, it didn't kick in until the first of the month. So it made me think, well, they don't start until the first of every month. But then another one said, no, it did actually happen on the 16th of the month. So anyway, the timing of this in the month is a little bit confusing too. We're learning that aspect of ourselves, and we're going to try to formulate a monthly deadline as to when your contribution changes need to be in by, as to when they take effect.
Have you ever gotten a clear answer on that from the R&I committee or Schwab?
No, nothing.
And we've asked.
Oh yeah. Nothing whatsoever. So anyway, so the whole point is, so there's 2 places to check your PRAP contributions year to date. It's on the schwabplan.com website, or schwab.com/PRAP. And check them on there, and then also on your pay stub. And that's typically what I do if I'm helping a client do that. I'll say, just tell me your pay stub. I can look on there and see exactly what your contributions are year to date, and then calculate what company contributions are. So there's a couple different places to check what your contributions are. So, yep. So just double check those and turn your post-tax contributions on if you're coming up on that time for it.
All right, tell me now, there may be some changes in spillover locations or destinations for next year. What do we know about that?
Yeah. So I think we've talked about the market-based cash balance plan with everybody, the MBCBP as we call it. So the anticipation is that thing is going to be turned on for 2025. So next year. There's no official word on that yet, but what we anticipate is the R&I committee coming out later this year saying, hey, the MBCBP is gonna actually happen in 2025. Again, we don't know that for sure. But when that happens, we will come out with guidance as to what to do, the consideration. So another thing we don't know yet is whether we can make a one-time contribution into the market-based plan, or whether we can make an annual, not a not a one-time contribution, but a one-time election as to
Right.
where your spillover goes, or whether we can do an annual election, or possibly even split the two. We don't know. We're still waiting to come out on that. Either way,
Delta had a one-time election, which is very unfortunate.
Yeah. So we are so we're waiting on that. The mechanics of how spillover happens into the RHA or the MBCBP, it's the same. That part's the same. It's just we need to make an election as to which one it goes into.
What's the biggest difference tax-wise and investment-wise between the RHA, HRA, and the cash balance plan? What's the big difference about what happens to that money once it lands in either one of those vehicles?
Yeah, good question. So the RHA is triple tax-free, right? So that's the biggest advantage of that. But the two disadvantages, again, there's a risk-reward trade-off in everything you do in finance. And so is that one, it's only used for medical expense, qualified medical expenses in retirement, which includes long-term care insurance premiums up to a limit, but it pretty sizable limit there. And then the other thing too, it's use it or lose it. So, which means if you or your spouse or a qualified dependent doesn't use it, it stays in the trust. In my opinion, depending on how much is in there, it's a small risk in my opinion. You know, so at least I generally tell people until it's above $100,000, don't even think about it, even if you're on military. So but other than that, so compared to the market-based plan, so it goes into, and by the way, the RHA, the Viva Trust, where the money is actually managed, goes into a Vanguard target date fund. And then when money goes into the market-based plan is that its spillover is going to be the same way. The biggest difference is that it's gross tax-free, but once it comes out, it is taxable. So it's just like an IRA or a 401k. And that's the biggest thing there. As far as how it's invested, I think it's going to be pretty conservatively invested also. I don't know specifically, but being that there is a certain amount that United is on the hook for this thing, because that's the whole idea of a market-based plan, is it kind of eliminates some of your downside risk if you just put money in and leave it alone. So it too is going to be pretty conservatively invested. However, that money can be rolled into an IRA later on. And so, and that's not a use or lose it plan. So those are the big things there.
Yeah. Yeah. And so just to elaborate just a second on it, let's say you've got $100,000 in your market-based cash balance plan, and the company has put in 102,000, and at retirement, the company knows there's a $2,000 loss in it, market loss. When you retire, before you roll it out, the company, if it's approved this way, and it should be, they actually have to dump an extra $2,000 in there when you retire and give you the whole 102,000. And that's why it's got to be conservative. But look, as your cash balance plan increases in value over time, we can just be more aggressive in your PRAP and keep your whole allocation where we want it as per your investment policy. So, so I think the tax ramifications, and then how you can spend the money with the RHA, like biggest differences, it sounds like. So cool.
Yep.
Okay.
Yep.
Well, the IRS is involved, so I'm not as optimistic, but they are still saying 2025. We'll see what happens. That's all we're waiting on, according to the R&I committee, is IRS approval. It took Delta more than a year and a half, so we'll see what happens.
Oh yeah. Yeah. So
cool. Okay. Anything else on your mind today?
Nope. I think that's a good recap of things that Alan and I are thinking about. What we've seen is Alan and I have combined forces in the past 9 months. Not that we weren't combined before that, but Alan has kind of taken on a lot more of the portfolio, kind of really paying a lot more. I don't want to say a lot more, but really concentrating on the portfolios, and I've kind of shifted over to kind of the financial planning side. So that's kind of the roles we have taken as we've decided to conquer this together. So it's good. Yeah. It's been working out great.
Yeah, and I should have done this at the beginning. Hopefully everybody's still on. Big picture, like Dan said, we're conquering together now. big picture questions, service requests, send those to client service at unitedwealthmanagement.com. Client service, one word, no spaces, nothing, at unitedwealthmanagement.com. If it's a move money admin request, Elizabeth Turner gets back with you. If it's a planning type request, it'll probably be Kim or myself and Dan. Investment type request, myself or Dan. So send it to that. We all check that all the time. And that way the appropriate person gets back to you. The one thing we're just going to keep hammering is please don't text Dan or myself anything related to United Wealth Management and your finances. We just, compliance wise, and I'm the chief compliance officer, it comes down on my head. We can't text anything related to your finances. So use that client service email address. Let us know what we can do for you. And we'll try and get another one of these out in a couple of weeks.
Sounds great.
All right.
Very good. That's all I got, Alan.
All right, man. Enjoy the rest of your day.
All right. Thanks.
Bye, bud. Bye.